All right, today we're jumping into a really fascinating financial thesis surrounding the stock BMNR. Now, there's a date on the calendar that has everyone talking, but the theory we're digging into today argues that, well, everyone might be looking at the completely wrong one.
And this quote, man, it just perfectly sets the stage. Most people who've been watching BMNR think the big dividend story is pretty much done. It's in the rearview mirror. But the thesis we're exploring says no way. It argues the main event, the real fireworks, well, they haven't even started yet.
So, let's get right into the central puzzle. According to this thesis, a massive misunderstanding about one very simple thing, timing, has caused the entire market to fixate on the wrong date.
Think of it like this. December 5th, that was just the qualifying round. The day you had to be on the list to even be eligible for the dividend. But December 29th, that's the championship game. That's the day the actual cash from the dividend hits brokerage accounts, and that's what sets the real events in motion.
Okay, but it gets deeper than just picking the right date on the calendar. This is where the story really takes a turn. It's not just about when the cash shows up. The real secret, the critical detail this thesis claims so many people are missing, is how BMNR's dividend reinvestment plan actually works. This one little technical detail, it changes everything.
So, for anyone who doesn't know, a dividend reinvestment plan, or DRIP, is super simple on the surface. It's a program that lets you take the cash you get from a dividend and, instead of pocketing it, you automatically use it to buy more shares of the stock. Easy enough, right? Well, here's the catch. Not all DRIPs are created equal.
And this is the crucial difference. This is everything. A lot of companies use what's called a treasury DRIP. They just print up brand new shares to give you. It's simple for them, but it dilutes the value for every other shareholder. But BMNR, they use an open market DRIP. And what that means is that every single dollar being reinvested has to be used to buy shares that already exist, right on the stock market. Your broker is forced to go out and physically buy stock, creating real, actual buying pressure.
So what's the result of that? Well, on December 29th, an army of what the pros call price-insensitive buyers is just unleashed onto the market. Now, these aren't humans weighing the pros and cons of the stock price. These are brokerage algorithms. They have one simple robotic command: take dividend cash, buy BMNR shares. That's it. It doesn't matter what the price is. The command is to buy.
I love this quote because it just hits the nail on the head. You hear about a penny per share dividend and you think, who cares? It's nothing. But when you multiply that one little penny by millions and millions of shares, and then you force all of that cash into the market to buy a stock that has a limited number of shares for sale, that little penny stops being a penny. It turns into an absolute wrecking ball.
Okay, so you might be thinking, this is just a bunch of small individual investors, but no. This is where the big guns come in. We have to talk about the institutional funds because they are a massive amplifier in this whole equation. Maybe the most important parts.
See, for these huge funds, reinvesting a dividend isn't really a choice. It's not some portfolio manager sipping coffee and deciding what to do. It's often a requirement that's literally written into their legal mandate, their DNA. So it's an algorithm that executes the command, not a human. According to this thesis, that makes this buying both automatic and totally unstoppable.
All right, you ready for this? Because this next part is where the thesis goes from just interesting to absolutely wild. It's this idea of funding your own demise, which the thesis calls the perfect trap.
Here's the deal for anyone betting against the stock, the short sellers. They don't just get a free pass on the dividend. No, they have a legal obligation to pay that dividend too. And they have to pay it out of their own pockets to the people they borrowed the shares from.
And this creates this terrifying feedback loop. Let's walk through it. Step 1, the shorts pay the dividend cash. Step 2, that same cash goes right into the hands of the longs, the institutions we just talked about. Step 3, their automatic mandated DRIP kicks in. Step 4, their brokers are now forced to go out and buy BMNR shares. Which leads to Step 5, the share price gets pushed up, which directly hurts the short seller's position. They are literally paying for the ammunition that is then used against them. It's a crazy loop.
So you've got this massive, predictable, robotic buying event locked and loaded on the calendar for December 29th. What do you think happens? The market isn't dumb. It doesn't just sit on its hands and wait for things to happen. The smart money starts to anticipate, and that creates a potential chain reaction.
Exactly. The pros, the big trading desks, they see this tidal wave of forced buying forming on the horizon. They're not going to wait for it to crash on top of them. They're going to try to ride it. And that means they start buying before the 29th, trying to get in ahead of the curve so they can sell their shares to that incoming flood of robotic DRP buyers.
And that is how you potentially get the perfect storm. You've got 3 different waves of buying all converging at the same time. First, you have the smart money, buying in anticipation. Second, you have the massive mechanical dividend buying that just has to happen. And third, if the price starts moving up quickly, you could get panicked short covering. That's when short sellers give up and rush to buy back shares to limit their losses, pushing the price up even faster. A predictable trickle of buying can suddenly become an unpredictable tsunami.
All right, so let's pull all these threads together. We've talked about the date, the plumbing of the market, the big institutions, and the psychology of the traders. So what's the final verdict here? What is this thesis really saying? It really boils down to these 4 key pillars. Number 1, the real catalyst isn't in the past, it's December 29th. Number 2, this is all happening on the open market, which means it's real buying, not just printed shares. Number 3, all of this creates a robotic buy wall of buyers who don't care about the price. And number 4, the craziest twist of all, the shorts are the ones funding the very buying pressure that could cause a squeeze against them.
And that brings us to this final quote, which I think just encapsulates the entire argument. The idea is, if you're on the other side of this trade, you're not just arguing with people who are bullish on the stock. You're not just betting against the company's fundamentals. You're fighting against the literal plumbing of the stock market. And that is a very, very tough fight to win.
Which leaves us with one last, really provocative question at the heart of this whole thing. On that one specific day, December 29th, to anyone's opinions about BMNR, their feelings, their research, their valuation models, does any of it even matter? Or is this one of those rare cases where the cold, hard mechanics of the market simply take over and run the show? It's a pretty fascinating thought to leave you with.